welcome to Livewire Markets. I'm Ali Selby, and this is your ultimate guide to picking ETFs for income. Today, we're joined by an ETF expert. His name is Mark Monfort. Thank you so much for joining us today, Mark.
A pleasure to be here, Ali.
First up, I'd love to know whether you think ETFs are an attractive solution for investors looking for yield.
I definitely think that they can be part of a portfolio, even if you are a stock picker by nature. ETFs offer such a diverse range of access to different things that you might not be able to access necessarily if you were just picking single stocks. So they offer that diversity. If you wanted to get into fixed income alone, there's a high kind of watermark if you were trying to just buy bonds on your own, but with ETFs that offer that kind of fixed income play, as well as the equity ETFs that offer that yield and harvest yield, as some of them have in the names. ETFs are such an attractive way to get into it, but they do come with their risks as well.
Mark, is it possible you could take us through some of the risks?
Yeah, sure. So it depends on the type of ETF that you are looking at, but typically you've got two kinds: the passive ETFs that track a benchmark, and also the active ETFs that don't necessarily track a benchmark, but they are actively managed by managers. And the thing is, with the active ones, whilst they are built to outperform, they haven't always done so. And because of that very nature, and it just shows how hard it is for even the professionals who look at this stuff every day to outperform the market. And then on the flip side, the passive funds, if, for example, something happens in that fund, for example, overseas, we've got like GameStop and AMC type stocks that rocket to the moon with retail investors pumping that one up. If it's in and there was a clear example with AMC, which was in a cheap ETF index, it stayed in that cheap ETF index because the ETF could not rebalance until the next quarter or the next 6 months. So even passive comes with its pitfalls.
That's so interesting, Mark. I'd love to know whether size matters for investors when it comes to ETFs. I feel like, as you mentioned before, a lot of these ETFs are relatively new. They can be quite volatile as well. Does FUM matter?
Size can matter for certain types of ETFs. We do find that across the dividend and yield equity related ETFs, that when it comes to the larger ones, they do tend to offer more FUM. It's not a one-to-one kind of correlation there, but on average, the larger ones do appear to have a little bit more in terms of the yield that they offer to investors.
I'd love to actually talk about the products listed on the ASX. How many income-focused products, whether it be equities or fixed income focused products, how many actually are there?
Okay, the definition can be quite broad because even if an ETF is not by label or by description saying that, hey, we're an income ETF, there are those that offer dividends. Or in the ETF world, they call it distributions, but it's typically the same thing. However, if we were to look at specifically focused on income or yield or distributions, you've got the fixed income ones, which are the predominant one that most people think about. There's 39 of those currently listed on the ASX as well as Chi-X. And of those 39, there's 25 that are Aussie and there's 14 that are globally focused. But then apart from that fixed income, which just tracks along very nicely, very low risk, and you've got some yield there on a regular basis, there are also those equity ETFs, and those equity ETFs that track yield specifically. And there's Aussie and global focus. There's 16 of those in total. And of that 16, 11 are local and 5 are global focused.
There's not actually as many as I would have expected. I'd love to know how management fees, costs, and spreads compare between each of those products.
Sure. We'll take a look at what the industry, so the Aussie ETF industry average is in terms of management expense ratio, MER, which is typically the costs that you think about when you look at ETFs. The league average is 0.52% as at August 2021. 0.51 to 0.52, but around that 0.5% mark. We find that there are ETFs in this income/yield, whether it's fixed income or these dividend yield focused equity ones. They range from as high as 1% for Magellan's new FPAY, to as low as 0.12% for an IYLD play from iShares. So there is that kind of range there. And you mentioned spread. The league average for spread is 0.21% across the ASX and Chi-X ETFs, but that can get up as high as 0.62 for one from Switzer and also that Magellan FPay one, and even as low as 0.04% for spread for IAF, which is an iShares play. And you do want your spread to be low and your liquidity, if you're looking at that, to be high.
There's quite a large dispersion between returns and yields between various products. I'd love to know why that is.
Yeah, the dispersion is quite interesting because just because there is a really high return on an ETF, and StockSpot, for example, even talk about that investors need to look at not just the price returns or the yield, but look at the total return data that is published. The ASX and Chi-X publish that. The total return figure that they show there on a 1 month, 1 year, 3 year, 5 year basis, that takes into account the dividends. So it's the package of all of the above. And even if you were to do that and you see something with a great total return, it doesn't necessarily mean that you're getting that regular dividend income over time. And we do find that just because something if it is in that category of what we said was the 55 income type ETFs that focus on yield, even if we look at something there that has an attractive total return, it doesn't necessarily mean that its yield has been good. Or even more, if we take it a step further, it doesn't mean that its yield is something that we find attractive, because we find that some historical yields have been trending downwards and some, have been trending upwards or just maintaining their high kind of levels. But yeah, it's important to look under the hood with the data there. And we definitely try to provide that at ETFtracker.
It's definitely a difficult environment for investors looking for income at the moment with interest rates sitting near zero. I'd love to know, is an active approach key when investing for income, particularly using ETFs? Or do you think a passive approach is probably a better strategy for those looking for, obviously, passive income?
I always like to take it back to context, and it really depends on the investor. If I was a passive only investor, I would definitely look to active as something to incorporate even just a little bit into my strategy. Or if I was purely active personally, or whether it was only active ETFs that I bought into, I would definitely look at passive. The reasons for that is that because so much unknown is out there with whether or not we stay at lower for longer or rates do rise. If rates rise, for example, when you're looking at bond or fixed income ETFs, if you're in passive, you need to look at active, whether it's XRO from the Fidante and ActiveX people, or if it's eInvest's eCore, for example. The reason for that is because of bond yields and long dated versus short dated bonds, short dated or long dated bonds. And that is that when interest rates rise, the ones that will likely get punished, and we've seen this historically, have been those longer duration type ones, whereas shorter duration, which is typically what the active managers get into, will help protect you. The same thing can be said for equity ETFs. When we had that example earlier with the things that don't rebalance in a passive fund, if you're in passive ETFs, it's going to be harder to navigate that future, whereas active can move around a little bit more. We see that with ESG ETFs like IMPQ, being able to talk to management and being able to be a bit more, as they say, active in terms of their movements. But if you are inactive, I do think that there are some passive and cheaper options out there when you look at the management expense ratio and other factors, but there's definitely room for both.
Are there any active income ETFs that you find interesting at the moment?
Yeah, there are. So I'm looking at the moment at the two that I mentioned earlier, which is the Fidante XRO. The reason for that is because it's seen a lot of inflows. We track the monthly data from the ASX and Chi-X, but there's also the league tables that come out each week. Every Tuesday in my inbox from ETF Securities, who run a really nice report. I'm sure you've probably seen it. But whenever I looked at that, I was curious to see that XRO was always up there in terms of the flows going into it, whether it's investors being cautious or institutions, all that. And then the other one is eInvest's eCore. It's got a great Sharpe ratio. It's short dated duration, and it is that active element. And then the final one is a new one from Magellan, which is FPAY. And I think that's been interesting because it's had some positive returns and some positive metrics coming out of it when we look at inflows over the first couple of months that it's been in existence.
As a researcher in this space, are there any interesting thematics that have recently caught your eye?
Yeah, if we're talking about yield and income type ETFs, I think that there is a thematic that I'm seeing that is interesting. Typically, when people talk about thematics with ETFs, you're thinking robo or cloud or clean energy or anything ESG, even Bitcoin, for example. And we're close to listing a Bitcoin ETF, I would hope, here in Australia, that is. But in the income and yield kind of play, typically people will think about it as a spectrum, or it's black and white. It's either you're into fixed income ETFs for yield, and that's the only thing that you do, and everything else is equity ETFs, and you don't care about the yield, or you are chasing yield with your equity ETFs. But on the risk return spectrum, there is actually something that sits in the middle, which is not as risky as equity, but it offers better returns than you would typically see in fixed income, and that is hybrids. And there are a few hybrids that are out in the ETF world. There's 240 plus ETFs in Australia. And so a few of those, not many, but there's a few hybrids. But one that's interesting that's caught our eye recently, and we're going to look into this more, is something from eInvest again. We mentioned it before, but they launched something last week, which is going to be listed as an ETF by eInvest. It's managed by Daintree. It's called DHOF. That's the Daintree Hybrid Opportunities Fund. And as something that is offering investors just something a little bit different, I think that the hybrids are definitely one to keep an eye out for.
Are there any thematics that have run their course or you think that investors should steer clear of?
I think there is data to show this for some, but it's not a hard and fast rule. But the analogy is that if an ETF issuer is listing it, then that's a sign that that trend has run its course, because the trend has made its money. Now an ETF sees that it's popular and then it lists it, so it's too late. But that's not always the case. So for example, robotics are a great one to look at because robotics have done really well even after being listed. There's quite a few things going on out there, whether it's scandals and crises that are overrunning different markets, and everyone's ETFs and portfolios are being hit by a certain company out of Asia. But what we think here is that this is definitely an opportunity to look at those that are not so poorly in terms of how their trends are looking at. And when we look at the ETFtracker and the trends that are going on there within certain sectors, whether it is technology or factor-based ETFs or even property, for example, which has done super well, I think that there are definitely those that you can look at and see, well, everyone's getting out of that. Which are the ones that are actually doing better and we can still get into. So I would turn it around and say that there's actually opportunities when you see crisis going on like we see now.
Okay, Mark, last question for you today. We asked you to bring along a model portfolio for investors looking for attractive levels of yield and returns in the current low interest rate environment. What are some of the different ETFs that are in that portfolio?
Sure. So because this is an income kind of focused talk, we're caveating all of this with we are picking those that do provide that regular source of income. But at the same time, they're actually great ETFs as well. So first of all, we're going to look at a local ETF, which is focused on equity and dividend yield providing type ETF. And that's VHY from Vanguard. And VHY is interesting because it's large. So it's been proven. A lot of investors are really into this. It's had really strong track record and performance. The fees are really low for this passive ETF. So it's something that can be attractive for those that are looking at that. The other thing is that yield has been quite strong for it. It has been decreasing a little bit over time, but it is made up for with its total returns. And then the other thing that we're seeing is that even though this has been established for some time, we're still seeing an uptick in terms of trades. So it's like it is a young ETF in the way that it's acting in terms of the way trading is happening, because it's still seeing that hockey stick curve up. But yeah, it is well established. So we like that one. For global, we like UMAX, and UMAX is one that is interesting. So UMAX, it's had strong returns and it gives you exposure to the S&P 500 and the dividend yield coming from that. And so we like that for global exposure. And then another one in the equity space is actually outside of those specific, whether it's in the name or the description, specific income focus ETFs. And it's something that we've seen do really well this year, which is a property play. So there's global and local property. This is SLF. And that one's quite interesting because it's had very strong performance this year. And it's actually got a decent dividend yield, not as high as the income focus kind of equity ETFs or fixed income plays, but as a normal ETF that people might be looking at for various other reasons and not yield, it actually offers an attractive yield. And then finally, we would round all of this off because we do see that there is uncertainty in the market with two fixed income plays. And the reason we're having these ones is because, as we mentioned earlier, they're active fixed income. They've got that ability to move into short-dated exposure if rates do rise. We're looking at XRO and also eCall.
Okay, Mark, just quickly before we clock off, I'd love to know, given your expertise in this area, if you have any final tips for investors.
Sure. Whether it's income and yield chasing investors or just investors in general. And it doesn't even have to be with ETFs. Sure, we look at ETFs ourselves, but the kind of age-old adage with ETFs has been to say, look under the hood. And people talk about do your own research, DYOR, across all the Reddit, Facebook forums. But it really is true. If you do look at the data and all the metrics and all the information that is available somewhat for free online, then that is a stalwart quality of due diligence. And we firmly believe in it. And I think investors should too.
Thank you so much, Mark. It's been an absolute pleasure to talk to you today. Thank you again.
Thanks for having me.